And so the whales, what we call the smart money, they're buying the dip. I think this is a great time to add to your bags to buy the dip. I'm certainly a buyer at this range. We saw guidance from JP Morgan. They put out a report maybe a month ago, and they called it the debasement trade. And they put both Bitcoin and gold together, saying that both of them are going up because governments will never stop debasing the currency. They'll never stop printing money. So they showed that the mechanism for both Bitcoin and gold is the same, governments debasing their currency. But at the same time, the markets are sort of pricing those two assets differently, as we're seeing right now. So when there's liquidity crisis that's happening right now, to your point earlier, the markets, the Fed's flying blind from data, et cetera. In this risky environment's happening, Bitcoin's selling off while gold is going up. So
according to Mark Moss, the true narrative that is currently taking place is about the fundamental fissures that are developing beneath the global financial system rather than just price fluctuations. According to Moss, when market liquidity starts to decline, chaos ensues. Major players start liquidating large positions in stocks, bonds, and even Bitcoin when they are unable to obtain cheap loans or are compelled to reduce their risk. Additionally, Moss identifies a pattern that is consistent with clockwork: big blocks of assets being dumped all at once at critical liquidity windows. This is mechanical, intentional, and anything but natural. Moss warns that these events create misleading short-term volatility, masking the much bigger shift happening behind the scenes: a transition away from the old financial system and toward decentralized alternatives. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
Well, what happened is you have these major market makers and blowing up. And so then what happens, they have to unwind these positions. And I saw this chart this morning on Twitter. It looks like every single morning at 9:30 a.m. Eastern, a big seller is coming to the market and dumping Bitcoin into the market. And so what that is it's structured selling. Somebody's trying to unwind a position. Healthy markets wouldn't do that. And so somebody is showing up every single day, dumping. And what's interesting, if you look at some of the on-chain, or not on-chain indicators, but more of like the technical analysis indicators, we can see the lowest daily MACD in history. Now, what's interesting is it's the lowest MACD in history, but Bitcoin's only down 33% from its all-time high. Now, only 33%. What do I mean by that? Well, if you zoom out and look in this bull run that we've been on since about 2022, when Bitcoin was down in the about 16 to 20,000 range, this is the third pullback of about 30%. So 30% drawdowns in Bitcoin are kind of somewhat normal. In other bull runs that we've seen in the past, like in 2017, we saw 7 of them happen. And so while it's only down 33%, not 80 or 90%, the MACD is at the lowest point in history. We see RSI at 21. It's only been that low 4 times in 5 years. We're talking the COVID crash, the FTX collapse, but like we're nowhere near that, right? We don't have this macro shock going on. There's no credit event going on. And like I said, Bitcoin's only down 33%, which is sort of in line with it. And what I would say, we can talk about more, but what I would say is that when you see this forced selling, a fund is being forced, this distressed market makers being forced to unwind this position, I would look at the opposite and go, man, the market is absorbing that and scooping that up like a boss. For when the liquidity is coming back in, I think number one, I mean, we look at the Fed's ending QT and most likely starting QE again. I think that's really big. Number 2, we'll start to look at those rates coming back down. I think that's going to be really big. And then I think we'd continue to look at a lot of the spending that's happening as well. So keep an eye on all the major central banks. Keep an eye on those liquidity levels. We can see that in the U.S. specifically, sort of this liquidity levels have been dropping, as I said, because the government's been shut down, things like that. But I think all that's reversing. I expect it to be pretty strong and pretty bullish through next year. I'm bullish on assets because I believe the governments will always have to print money. Now, to your point, there are some dangers that we see in the market. We can certainly hit some more liquidity pockets. We could certainly trip some more circuit breakers like we saw here, and we could see some selling. But I think any type of selling that we'll see in the market overall broadly will be swiftly met with more money printing and more stability. So I think any type of, maybe black swan or gray swan events that might trigger some liquidity crisis in a broad general market sell-off event, I think will be swiftly dealt with by the Fed. And so we'd see like this very rapid V-shaped recovery. In my opinion, it would be so fast, I'm not going to try to trade that position. Again, because I'm a little bit longer term, I'll look at that as a buying opportunity. But if I'm shorter term, then I might want to reduce my exposure in some of these areas where I see some risk, like the AI stuff. I might want to hedge some of my positions if that's the case for me. And so you can see the wells, the amount of wallets that hold more than 1,000 Bitcoin are accelerating. You see some of the big funds that have been coming out, even Harvard, you can see that their buys are going up. And so the whales, what we call the smart money, they're buying the dip. I think this is a great time to add to your bags, to buy the dip. I'm certainly a buyer at this range. Yeah, well, obviously, to your point, right, we're flying blind. The Fed doesn't know what to do.
Yeah.
Come on. We know what the Fed needs to do. They're going to cut rates. They already told us they're going to cut rates. Again, personally, I think about this from a little bit of a longer term perspective. Trump has been very vocal. He wants rates down at 1%. He's told us that. He's told us that for a year. He's always been banging on the Fed to lower rates. Trump has a way of getting what Trump wants. Powell said they're going to lower rates. Not only are they going to lower rates, a lot of the Fed presidents are saying they'll start QE again, start buying assets again. And either way, Jerome Powell's out next year. Trump will replace him with a dove. And I'll make the prediction here. Before Trump leaves office, we'll probably see rates closer to the 1% number Trump wants. So that's very bullish. But where are we at, for this next meeting that's coming up here in a couple of weeks? Jerome's flying blind. Again, if you zoom out, I don't think it's that big of a deal in the big picture.
By taking a highly volatile asset like Bitcoin and building multiple types of yield-bearing financial products on top of it, MicroStrategy is breaking new ground. They're creating an entire spectrum of instruments, stable income products, institutional-grade credit instruments, and even high-yield junk bond-style offerings, all backed directly by Bitcoin. Most investors still have no idea how big this is. This is the start of a completely new financial system. Just like the early days of electricity or the early internet, people don't recognize the transformation while it's happening. And this is exactly what Mark Moss emphasizes. Short-term price swings are nothing more than noise. The long-term fundamentals are not only intact, they're stronger than ever. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content before we go any further. Now, let's get into his powerful predictions.
To the point, right now we see that gold is still the main risk-off asset for central banks. We can see this sort of global regime change trying to de-dollarize, trying to get into a new system. China has been pushing gold. And so we can see there's this massive demand for gold, and I expect it to continue to go up at a really good rate. But I would say that maybe the demand drivers of Bitcoin and gold, while I might look at them as both this long-term risk-off asset, the market doesn't really see it that way. And so gold is still that risk-off asset, whereas Bitcoin, the market is still sort of pricing it like this risk trade. Now, we saw guidance from JP Morgan. They put out a report maybe a month ago, and they called it the debasement trade. And they put both Bitcoin and gold together, saying that both of them are going up because governments will never stop debasing the currency. They'll never stop printing money. So they showed that the mechanism for both Bitcoin and gold is the same, governments debasing their currency. But at the same time, the markets are sort of pricing those two assets differently, as we're seeing right now. So when there's liquidity crisis that's happening right now, to your point earlier, the markets, the Fed's flying blind from data, et cetera. In this risky environment's happening, Bitcoin's selling off while gold is going up. So the underlying long-term fundamental drivers per JP Morgan are the same, monetary debasement. But in the shorter term, the drivers are a little bit different. The short-term price action is hostage to the market. I don't think it means that the asset is a hostage. So what are we talking about? Sort of what you said, it's a plumbing issue. So what happened, I think, is leading up to what really caused this to happen. We'll get into that, what Fundstrat said. But since the ETFs went live on Bitcoin, we've seen the volatility collapse. In order to overcome that, what we've seen is that the trading has become over leveraged in Bitcoin and the crypto market overall. And so we've seen this massive buildup in leverage because that volatility has been lower and the complacency was high. So you sort of have that buildup. Then what happened is on October 10th, 10/10, Trump put out one of his tweets that likes to move the market, and he said he was going to slap 100% tariffs on China. Just like we saw in April, that sent the market reeling. The market started collapsing. And what happens, because one, we have the over leverage, as I already said. Number two, we have so much of this algorithmic trading going on. So as the market starts moving down, it starts sending a cascading event, and it created the largest liquidation event ever recorded. About $20 billion in leveraged positions were completely wiped out in less than 24 hours. It hit about 1.6 million accounts. And normally that would happen from, massive macro shocks, something like that. An exchange blew up, something like that. But that's not what happened. It was to the point that Tom Lee made, you brought up, a major market maker blew up. And so we've seen a couple of them that have actually blown up. Looks like Wintermute maybe went down. Maybe another exchange went down. He doesn't really want to name them. But we started seeing this liquidation. And what happens is you have something called ADL. It's automatic deleveraging. So what happens is as this liquidity starts to dry up, these accounts, looks like Binance being one of them, started to liquidate or close people's positions, even though they're in profit. So it closes positions indiscriminately, and it's taking the profitable trades and sort of socializing the losses, if you will. And that's exactly what we saw. We saw the other account, I think what maybe he didn't want to name them, but it looks like Stream Finance. That's a major delta neutral fund. They're about 200 million AUM. It literally blew up because of this ADL cascading. And so that seems to be what happened. It was like this anomaly. It was the plumbing. He calls it a glitch. I don't know if that's the right word for it. It's just the way the system is built. We probably need to take a look at that, rethink how that is. But that seems to be what happened.
As we come to a close, the most important lesson Mark Moss imparts to us is to distinguish between short-term turmoil and long-term reality. The market's events did not indicate Bitcoin's downfall. It wasn't an indication that something was seriously flawed or that the asset was weak. It was the outcome of a highly leveraged, overloaded system responding to an unexpected shock. It was a technical flaw in the way modern markets are constructed. Moss wants viewers to understand that these temporary price drops are noise. They come from broken structures, fragile leverage, automatic liquidations, and algorithmic trading, not from Bitcoin losing its value. In fact, he argues the opposite. While traders get wiped out, the long-term fundamentals of Bitcoin and the new financial architecture being built around it are becoming stronger. He emphasizes how Michael Saylor is developing yield-bearing instruments on top of Bitcoin in order to create something revolutionary. Similar to the early days of electricity or the internet, when people were unable to predict the extent of the transformation, we are in the early stages of a new financial system. Moss's argument is straightforward. Early mistakes are normal because we are seeing the emergence of something completely new. Therefore, even though the price may fluctuate significantly, the innovation should ultimately continue. No matter how dramatic, this moment is only a portion of the learning curve. Eventually, the infrastructure will get better, the markets will adapt, and the underlying pattern won't change. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.